But the next big move is 90. It's going to pause before running 100. So whatever it does do, let's say it comes a little bit back, that's next key interim level is at 90.9. My eyes, I need to check. 90.68, around $91. So we're going to pause just shy of 100, or we might just do a technical run of the 100 and get rejected and churn around here for a while. And then the next move is 333 for me. So these open areas between the targets are typically carried with immense, but it's not the same dollar, and there's going to be potentially some degree of crisis that could go along with it. So this is an incredibly positive time.
Francis Hunt, known as the market sniper, says gold's long-term price history tells a clear story of acceleration. From 1883 to 2008, it took 120 years for gold to reach $1,000 an ounce. The next $1,000 move, from $1,000 to $2,000, took just 12 years. Then gold needed only 5 years to hit $3,000, and less than 6 months to touch $4,000. That's not a steady trend, it's an exponential one. Each stage comes faster, with more force and less time in between, which is exactly what defines a parabolic move. When markets go parabolic, Hunt says, logic gives way to emotion. People stop waiting for pullbacks or worrying about overvaluation, they just want in. That surge in urgency thins out market depth. Bids and offers become uneven, so when selling hits, prices drop sharply before stabilizing. It's not a top, it's volatility born from speed. Gold's pullback, then, isn't a warning sign, it's a recalibration. The metal is simply adjusting to a higher price range as the dollar weakens and global liquidity expands. For decades, gold lagged behind monetary growth. The 1980s and 1990s saw the financialization of everything, when Paul Volcker's rate hikes made bonds attractive and pushed gold from $800 down to below $300. Now, Hunt argues, gold is making up for lost time. It's finally aligning with decades of unchecked debt and currency debasement. The parabola we're seeing isn't a bubble, it's gold repricing itself for a new era, one where fiat money is visibly losing credibility and real assets are reclaiming their true value. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
I've got a gold chart that goes back to 1883. The first $1,000 to make it took 120 years. It was 2008 that we got the first time we crossed $1,000. So that was 120 years. The time duration to the next $1,000 was 12 years. So you went from 2008 to 2020. I think you'd agree that's quite a reduced rate of time for the same movement in dollars. Then the next 1,000 from 2020 to the point where we ran 3,000 was 5 years. So it was 2020 was that high, and we did 3,000 this year, mid-year. Then the next 1,000, where we actually ran 4,000, was under 6 months. So you've gone 120, 12, 5, 0.5. Now, if anybody understands what a parabola is, when you non-log a chart, and I'll show this visually in a minute, but it is when you're achieving a linear chart is 1 unit of time, 1 unit of climb. That's a 45-degree angle, and it's quite linear. And if you do another unit of time and you do another unit of climb, you end up with a 45-degree line. If you are doing 120 years to get 1,000, and then you are doing 12 to get your next 1,000, and 5, and then 0.5, what you're actually getting is ever reducing time frame, yet the climb rate is ever higher. That's the definition of a parabola. Many people are not quite clear what a parabola is. It's an exponential move. It's not to a multiple like 1x climb, 1 for 1. It's actually each time it's more juice for less time. And that's an exponent. It's like when you cube a number, 1 cube, 2 cube, 3 cube. By the time you get to 4 cube, it starts to be quite a big number that's coming out. And that's where we are on gold. So what tends to happen is when you're getting more parabolic, there's a lot of people that are recognizing it's parabolic and just can't afford not to be in. So they just chase and hit the stack. All sense of pricing and value, it's just about get me gold, get me silver. What that happens when that happens, typically you have an order stack and a bid stack. And normally it's proliferated with depth with levels that people are prepared to get in. When you get price advances that accelerate too fast, you get a bit of a thinning of the bid and order stack because it's moved too dynamically. And what that means is it starts to overshoot. And then eventually you get to a point where some people will say, well, it's a bit much in such a short time frame, could have a pullback. The sellers start to sell, and the bid stack hasn't built up. So there's less volume. So they push it further down. It's just the introduction of volatility. What happens is people's need to get used to an entirely new level and standard for gold price and fiat debasement, because it's actually restricted by our paradigm of ability to understand where it should be. And when you talk about the metals markets, they actually went down during the financialization of everything years. The financialization of everything years was from the Volcker period where he spiked rates. He killed the gold bull at the time and resaved the debt markets and pushed rates so high. He made bonds so cheap that they actually became potentially quite valuable. And then we had the 40-year bond cycle. During that period, gold, there was still inflation. There was still an expansion in monetary supply. Gold should have been doing a linear increase according to the M2. And in fact, the M2 itself started to be more of a parabola, but gold actually went down from its 800s, well down until it hit a lows around 200s in 99, going 2000. Just as we were having one of our first major bubbles, being the .com. And that was basically the bottom of gold. It started to move up, but everything else was still moving up faster. So what's actually happened is we're getting a parabola now for all the back pay we're owed for when gold should have been doing what the M2 was doing and actually was going in the opposite direction.
Francis Hunt says silver's recent pullback isn't a surprise. It's part of a larger technical setup his team has been tracking for months. Even when prices were breaking above $50, he expected the market to pause before any real breakout. What's happening now, he explains, is a measured correction, not a panic-driven reversal like those seen in previous cycles. He describes silver's long-term structure as a 3 times a lady formation. In that pattern, the market tests a key resistance level 3 times and fails, but the 4th attempt breaks through decisively. Silver has already made its 3 pushes toward the $50 zone. This current pullback is, in his view, the setup for that 4th and final surge. Once the correction completes, Hunt projects a powerful move toward $90 to $91, where silver may consolidate briefly before challenging $100. Beyond that, his long-term technical target reaches all the way to $333 per ounce. He adds that silver's biggest rallies tend to align with moments of financial stress, times when the global system wobbles and investors scramble for tangible assets. That's why he believes the next major leg up in silver won't just be a technical breakout, it'll be a reflection of deeper cracks in the global financial order. Let's get back to the interview.
So particularly with regards to silver, you may recall when we spoke that on that silver, we said there's a 45 to 50 range that we think that there's going to be, we go once, twice, 3 times a lady. And many people that draw the classic, what they call the cup and handle, you've had the once of the 1980, you've had the return. We'll go to silver, and I think I'll answer. Let me do that right away because that's your current question. So yes, we foresaw a pullback. We said you're not going to get your face ripping move yet on silver, which tells us that gold, the whole complex, will likely have a rest. And here's the chart for silver. Let me just put it on a quarterly and pull that through. So we said it's quite likely at this range. We put a box on it. We weren't able to give it you an exact price point, but we said as you approach 50, quite likely that you're going to receive some form of pullback. You may recall that. And we use that catchphrase to help people remember that we did say that. We go once, twice. It's the Lionel Richie song that I'm having some fun with. I can't say I was a huge fan, but it did stick out. It was played so often. 3 times, and then your lady. That's your winning. You've walked off with the beautiful girl. That's it. It comes there. But 3 rejections. She says no to you 3 times. And on the 4th time, you're going out for that date together. And this is a bit of a shooting star here, and there is a pullback. How on the bigger time frames, it's going to be interesting to see where the month ends. It does point to an inter-rejection. You can see, for example, that was a violent one, a more violent one, and it did lead to further downside. This is actually by log scale, not particularly violent. And we said the pullback will be less and not as deep. And this is the next big move. This is the primary move. This is your most exciting move coming. And it's you once you've hit 3 times, you have to wait for that dip to do it. So we did predict that. I mean, we also paired it with Mario, and he was saying, no, I think it just ripped straight from here. And we were saying, no, I think despite it looking super strong right now, that was while this was happening, and you were up at the 54s, we still think you get that rejection. And it came a little later, but there's a little bit of an inflationary tilt to this. This high is tiny bit higher than that one as well. You've got to remember there's a certain time period between each of these and again, the fiat debasement. But so if we do our HVF method draw, which is something that we're unique, we'll recap the silver targets with you. I just have to make one adjustment for this slightly higher high on the second one. It's so close, and we make it just a minor imperfection, 49.81428. That is the high there, and we say leave that one out, and this is what you get. So here's our setup. Now, HVF method is our unique trading methodology, and it got us long this trade well before the cup and handle guys were in here. For them, it was only interesting once we got to the $50 mark, or the $45, $50 mark. For us, you broke over here, and that was still in the 30s. And your stop loss is there, and this has made what we call our first interim target. And typically after running that line, you'll see it there at $40, 40.92. So once you've run 41, you typically get at some point some degree of pullback. Now, how far does the pullback go? Our worst case scenario would be a revisit to our green line there. It doesn't have to do that, but sometimes it can happen. It's called a return move to the triggering event here. That would bring you right down to the 30s. I don't feel that. This rejection is nothing like the scale of that shooting star rejection. But the next big move is 90. It's going to pause before running 100. So whatever it does do, let's say it comes a little bit back, that's next key interim level is at 90.9. My eyes, I need to check, 90.68, around $91. So we're going to pause just shy of 100, or we might just do a technical run of the 100 and get rejected and churn around here for a while. And then the next move is 333 for me. So these open areas between the targets are typically carried with immense, but it's not the same dollar, and there's going to be potentially some degree of crisis that could go along with this. So this is an incredibly positive time.
What's unfolding in the precious metals market feels less like a rally and more like a reckoning. Gold and silver aren't just reacting to price charts, they're responding to decades of financial distortion finally coming to light. The speed of gold's ascent isn't a coincidence, it's a mirror reflecting the rapid deterioration of paper currencies. Every uptick signals a vote of no confidence in the system that promised stability but delivered inflation and debt. Silver's structure tells a similar story, each pullback acting as a coiled spring, storing energy for a far more violent move ahead. This isn't about speculation anymore, it's about repricing truth after years of denial. We're entering a stage where numbers on screens are losing meaning and tangible value is regaining authority. As monetary policies stretch to their limits and faith in fiat erodes, gold and silver are stepping back into the roles they've played for thousands of years, anchors in a storm of credit and confidence. The acceleration Francis Hunt describes isn't just technical, it's psychological, even historical. The question now is whether this transition will unfold in an orderly way, or whether markets will force the reckoning faster than anyone is prepared for. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.